Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes coming to you live from Orlando, Florida for episode 179 of our VideoCast, 169 of our podcast for the week ending March 23rd, 2023. The girls are down here for age group national championships. So we're very excited. They've been putting in personal best times, crushing it. Nationally ranking. We'll get to some more details next week when we get through all the finals over the weekend, but very exciting stuff. And as we like to do anytime we're on the road, we visit all of Guy Fieri's restaurants, from diners, drive-ins, and dives. And our latest venture was on night one, where we went to Saigon in Orlando, which was Vietnamese. And we had the shaking beef as well as the beef pho, and it was absolutely phenomenal. So moving right along, more of Mimi and Annabelle. That's in a train at this kind of court area park in Orlando, where they have a big Ferris wheel and this really tall ride that you spin around on, etc. There's the Ferris wheel. So they're just having a blast. They're working hard, they're playing hard, and that's what we do. And that's exciting. So want to thank, we'll do some media. We've got quite a few AMA questions, and the feedback I've been getting is everyone really loves the AMA questions. They're learning a lot, so we're going to keep doing those as much as we can. So want to thank Manya Sayini and Jaivir Shekhawat for including me in their article on Reuters. Also want to thank Shubham Batra and Amruta Kandakar and Shristi Akar A for including me in their article on Reuters. And last Thursday, we covered some of this on last week's podcast, so we're not going to play it again. Want to thank Charles Payne and Kayla Arestivo for including me in Making Money with Charles Payne on Fox Business. I was able to join last week. So that's exciting. And the quote of the week that we're going to talk about is from Robert Arnott. He's one of the well-known small cap quantitative managers around. And he says, successful contrarian investing requires us to live with discomfort for being wrong and being alone for some time. But bargains do not exist in the absence of fear. Like I say all the time, they don't give away multi-baggers for free. Okay, they're going to shake you out. They're going to run you around. They're going to run you ragged. And if you can stay on that, galloping bull, for those who watch bull riding, you're going to be rewarded handsomely with the multi-baggers, with the high IRRs, and with all the rewards that the other people just couldn't stick it out and sold in the hole because they didn't know what they owned. They knew the price of everything and the value of nothing, and that's not how you make money. You do it the exact opposite. Want to thank Alan Woolman, longtime listener, first-time caller, I guess, for sending me over this trend chart, which I thought was really well put together. And the point that Alan makes is that, you see elevated trends, spikes of fear on the way up as you climb the wall of worry. And as the market's crashing, those kind of flatten out. And what we're at the beginning of here in this basing part, we're in this climb the wall of worry. And I happen to agree with him, and I thought this was useful. We do have videos on the website, What is Trend, but I'll just read it from Investopedia so people can understand. It's called the ARMS Index, also called Short-Term Trading Index, is the technical analysis indicator that compares the number of advancing and declining stocks, advance decline ratio to advancing and declining volume. It is used to gauge overall market sentiment. So you do see these fearful spikes on the way up as you climb the wall of worry. So we'll see how this example plays out as well. And I think it's going to be a similar type of story that's going to take everyone by surprise. Now, the keys to the market here, up and down every single day, it all comes down to regional banks. And until they backstop those deposits, we're going to continue to have this volatility. And the question is, how much pain do they have to assume? I'm talking about the government, the Fed, the Treasury, and ultimately the only person who can change this, because it either has to go through Congress, which takes forever, or a disaster, or the executive branch can actually do it unilaterally in periods of crisis. And I think this would qualify to either increase the deposit insurance so money stops fleeing out of the regional banks, or backstop all deposits, which would solve the problem overnight, and you'd probably have 1,000 points up on the Dow the next day. The reason this is important is because everyone is treating the symptom versus the root cause. And the root cause is the genie's out of the bottle. The Fed did not calculate 3 moves ahead when they decided to just recklessly, unyieldingly raise rates when they could have drained the liquidity by reducing the balance sheet and kept rates more modestly. And the unintended effect is that now no one trusts the regional banks. So all the money is going from regionals to the systemically important banks, which is basically 4 banks for all the uninsured deposits. And that's not going to stop until they backstop them. And once they do, then game will be on. The question is, how much damage do they allow to happen before they finally come to the rescue? They did it with the bank lending program. They took 2 days of unnecessary pain and stupidity before finally making the right move. The question is, how long will they do it? And we're going to find out very quickly. My guess is 1 or 2 more banks, and then they'll sit around and say, how did this happen? I have no idea. So yes, it must have been the risk managers at all the bank that had 5.7-year duration on U.S. Treasuries, ladies and gentlemen, U.S. Treasuries. They were not investing in non-government MBS and CMBS and crazy stuff to blow up their portfolio to try to juice yields. They were investing in government securities, and you had the steepest hiking cycle in history, and certainly in over 40 years. And that has consequences, especially when you don't allow it to settle into the system and let the impacts of the lagged effect work its way through the economy. So now you're going to have to come up with trillions more to backstop deposits, which is more inflationary than the ridiculous tightening you did to start with. So anyway, the keys to the market here are PacWest Bancorp. So when this stops going down, and First Republic. Okay, so these have been falling off a cliff from 27 to 9, and First Republic from 120 down to 12. Putting more deposits in is not going to help. I mean, the joke was Jamie Dimon got them $30 billion deposits. Jamie Dimon basically gave them back all the deposits that they received as a result of the Fed not doing the right thing and money continuing to flee from the regional banks to the systemically important banks. And these big banks now starting to tap up against the deposit cap that no major bank can have more than 10% of all of the deposits in a nation. And now you've got Bank of America and you've got JP Morgan knocking on the door. They can't even take any more of these deposits. So they're giving it back, but you can give it back all day long. If they're uninsured, they're going to keep trying to go back to the bigger and bigger banks, and these regionals are going to be toasted until the Fed finally wakes up. And they're saying, well, we'll just wait until it goes away. This was never a problem for a long time. Well, this was never a problem for a long time because you never hiked rates as aggressively as you did in over 40 years in such a short period of time without accounting for the unintended consequences of using a blunt, outdated instrument when you had a $9 trillion balance sheet that you could have taken down 3 or 4 trillion, drained liquidity from the system, and kept rates at a reasonable level of 3.5%, and achieved what you wanted, which was taking inflation. Instead, we're going to finish this tightening cycle with a record high balance sheet, probably over 9 trillion because of the stupidity around the banks, and abnormally high rates, which makes housing unaffordable, and a knock-on effect of screwing the largest demography of our country, which is the millennials, average age in the early 30s, trying to start a family, trying to start a home, and compliments of Jay Powell have made the entire process unattainable because he drained liquidity the wrong way and continues to double down on that. If you saw his speech, it's like he doesn't know he has other tools or seems unwilling or unaware of how to use them properly. So this will continue until they finally go all in and solve the problem that everyone knows they've had to do for the last 2 weeks, but they've refused to do. So this is what you see. This is the XLF down about 20%. This is creating opportunities, but if you are wondering why we haven't been taking advantage of the dislocation in regional banks and we only bought some Bank of America, well, now you know. Bank of America is going to be a beneficiary of this at the end of the day once it's resolved. And these regionals that are out raising capital, how can you possibly raise capital if you don't know what your deposit base is going to be in 2 weeks? And the answer is it's going to be a lot smaller until the government now steps in, and they can't keep ignoring it and saying it'll go away, because it won't go away. Once you break something, you have to fix it. And had they not broken it, they would never have this problem, which is going to cost more money and ultimately be more inflationary down the road. So stay tuned. Now, that sounds like I'm bearish. I'm not. Look at the high yield bonds are holding up. So that's a good sign in the short term. And they put in a major kind of double bottom here over the fall when it was scary times. And they're just working their way up, climbing the wall of worry. Eventually, the government will step in. The question is, how much pain do they have to take before they make the right decision? And with the recency bias of 2008, my guess is not a whole lot more. Moving right along to Seth Golden's post here. The percent of components with positive 3-month percentage change in forward earnings inflected from 47% to 60.4% last week. Now it's jumped again to 61.5%. This is from Bank of America. So this is a positive thing. Despite several recent bank failures, the global earnings revision ratio continued to show remarkable resilience in March and was unchanged at 0.79. The ratio jumped in Europe. For the global sector, ratio fell most for energy. Tech hardware remains surprisingly high for banks. Diversified financial direction of earnings expectations could be key to equity market performance in 2023. No kidding. So it will be interesting to monitor whether expectations remain resilient in the impact of tighter monetary policy as it ripples through the company. So that's that. But this continues to go up, and this is the key to the market. This is what you see coming out of recessions. There should be a gray line in the beginning of 2020 when we had 2 quarters of negative GDP growth, but there's not one, so people are faked out by everything. But as you can see, when you drop below this 50% and start to recover the market, and you're actually coming out of recession, so you can just draw your imaginary gray line here because the administration didn't want to acknowledge it. This is also from Ned David Research via Seth. We've talked about the cyclical composites. In this case is the 1-year seasonal cycle, 4-year presidential cycle, which we spent a lot of time, and 10-year decennial cycle, all compiled into one index. So far it's tracking a little bit of offset from this banking thing, but the strength continues in a pre-election year. And we think that's going to be true. And we think that, around the summer after you've had this rally is when everyone gets sucked in and you get your first correction, and then no returns for the rest of the year. So we are fully positioned to take advantage of this. And up here, if some of our companies have hit full or fair value based on what we estimate before we even enter the position or the company, then we can start to lay off some of them. Or just sit tight, depending on where it is. Moving right along, trader wages, $2 million of half-point cut by June meeting. So someone put a huge option trade on today, derivatives trade, anticipating that they'll have to cut 50 basis points after the stupidity of raising one last time yesterday. I think that's a little aggressive, and that's actually not what you want to see. Our base case is that they finish here and they stay here for some time. Hopefully they don't do enough damage. If they backstop the deposits, this market is going to rip through the roof and take everyone off sides and rip people like these apart. I think they'll have to do it. I'm just not sure how much pain they have to take before they finally make the right decision. But there's no going back. They created the problem. They have to fix it. This is from a guy over at Fundstrat, Matt Serminaro. Said the last time the NASDAQ 100 had this many advancers, the broader market ripped. Okay, it's kind of interesting. I tend to agree. This is just one of 1,000 data points. We don't rely on any one of these things. This one I just didn't take off. This is from Bespoke. Earnings have been able to keep up with estimates recently. Of the 12 companies that reported since yesterday closed, all 12 beat EPS estimates and 11 out of 12 beat sales estimates. I think we're going to see more and more of this moving forward. The big fear, was China was shut down in Q4. Things are starting to come back in Q1. So the article of the week, how did this happen? The stock market and sentiment results. and this is important. So you have Silicon National Valley Bank. You could say, oh, that wasn't me. That was a risk manager. But then you had Signature Bank of New York. You could say, oh, that wasn't me, tightening 500 basis points in 12 months. That was, maybe Barney Frank sitting on the board had something to do with it. I'm kidding. And then Credit Suisse, well, you say, well, that's not even a Swiss bank, but their portfolio. The bottom line is all of these companies got upside down. Yes, they could have had better oversight, but at the end of the day, they all had government bonds in their portfolio with durations of 5 years, which is not reckless. What's reckless is not allowing the lagged effect to work and continuing to raise like an idiot with your blinders on until you crash into a wall. And 2 weeks ago, they crashed into a wall. And we're going to see more of these. Maybe it'll be a couple of these regionals. The question is, how many have to blow up before they realize that they created the problem and they have to fix the problem? They did act 48 hours late on the bank term lending facility, but that was effective and that did work. We'll see. Maybe we get another weekday tomorrow, and then over the weekend they finally figure out how to backstop the deposits, at least on a temporary basis for 1 or 2 years, or increase the deposit insurance, or figure out some solution. So, and by the way, if they're so confident that the banking system is stable, it'll cost them nothing. So what are they worried about? They might as well stand behind it. As Powell was so confident yesterday, while he asked at the same time the simple question. The question we were all asking ourselves the first weekend, this is of the banking crisis, how did this all happen? I have absolutely no clue. How did this happen, Jay? We have no idea. Tell us what you think it is. So the bad news is we have a Federal Reserve with no feel for the market or explicit understanding of the lagged effect of tightening on the economy, or patience to actually sit and wait for it to impact the economy. To this point, the chairman was quoted in yesterday's conference as follows. The question we were asking ourselves was, how did this happen? Referring to the collapse of Silicon Valley Bank. Why don't you save the taxpayers some money and call off the quote unquote investigation? Everyone already knows what happened, Jay. You raised 500 basis points in 12 months and didn't wait for it to kick into the system, and we haven't even felt the impact yet. So just chill out, let it work through the system. You've got the leases rolling off on a 12-month lag over the next few months. CPI and PPI are going to fall, and your hero, Paul Volcker, by the way, actually stopped hiking rates when inflation was still 6%, and he, quote, won the war. So why don't you follow your hero and actually do the exact same thing, because now we're about to dip under 6%. I can already hear the Shaggy "It Wasn't Me" background music at the next Fed press conference saying it wasn't me, it was the risk manager. But when you start to pile 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 banks, you could safely assume that 15 out of 15 risk managers weren't the problem. It was the exogenous event created by the Fed, who was asleep at the wheel in terms of the unexpected consequences, and continuing to do it in the face of knowing about those consequences. That was the culprit. So as we anticipated in January and have reiterated in our weekly podcast VideoCast, the political pressure is just beginning. For the first time in my life, I full-throatedly am sympathetic to Elizabeth Warren's views, where she says Jerome Powell has failed and should not be Fed chairman, says Senator Elizabeth Warren. The Fed under Chair Powell made a mistake not pausing its extreme interest rate hikes. I warned for months that the Fed's current path risks throwing millions of Americans out of work. We have many tools to fight inflation without pushing the economy off a cliff. This is the key part. I don't care if he keeps his job or he doesn't keep his job. He's an exceptionally smart man, a successful man, and I believe a high quality person, human being, trying his very best. I just don't think his skill set is there in terms of what needs to be done right now. I was a pretty good hockey player growing up. I still play hockey every Saturday. But just because I'm good at one sport, you don't put me in as a basketball coach for my daughter's basketball team. They don't play basketball, but if they did, that would be an absolute mistake. I think Powell would be a brilliant Treasury Secretary. I'd love to see his signature on our currency, but especially the amount that they're going to have to print, his hand would get tired. But leaving that aside, I think he's phenomenal. I just don't think he's phenomenal for this job. And as a matter of fact, the simple solution would be to actually swap him out, put Yellen back in and put him at Treasury Secretary, and he'd be great. I covered the Fed's role in the SVB crisis on Making Money with Charles Payne last Thursday, along with some new picks. Thanks to Charles and Kayla for having me on. You can listen to that again if you missed it last week. this continues to be a shoot first, and this is where I cover that they should be using the balance sheet tool versus the blunt instrument of rates, which is serving to do only one thing, which is screw 82 million millennials who are trying to get their lives started with houses and families and that type of thing, which is the driver of growth historically. So this continues to be a shoot first, ask questions later market for regional banks. The bank term lending facility was an important measure, but until we get movement on an explicit deposit insurance increase or full coverage, you're going to continue to see these cracks in the market. Pandora's box, which is why you saw the rally fall away today. Pandora's box was opened by the Fed's unyielding rate hike campaign until something broke. So if we feel that nothing's going to change until they change, why would we have any money at risk in the market? And the answer is because the businesses that we own are at such a margin of safety relative to the quality and their ability to compound wealth over time that whether rates are 7% or 3%, it's not going to dramatically impact their long-term earnings power. And to the point, Buffett always says, price is what you pay, value is what you get. We've paid exceptionally abnormal prices for such high-quality businesses that were created by the pandemic, by certain supply chain issues, by once-in-a-100-year events, and they've got long enough decades-long track records that we can feel confident whether the market has to correct another 5% or you wake up to an announcement where they backstop deposits and it rallies to 1,000 points in a day, because then all the problems are over overnight. You can't afford to miss that, because if you wake up to a +4, you're toast. If you have to deal with a -4 for a few weeks, it's not the end of the world, because you're not on leverage, you're not on margin. The thing about margin is dumb people shouldn't use it, and smart people generally don't need it, unless you're dealing in real estate. Of course, you can be levered 50% or whatever it happens to be. So as it stands, the only banks that are fully insured are the SIBs, systemically important banks, and until the government steps in to change that, we will continue to see flows away from regionals and into SIBs that are too big to fail. The genie's out, no matter how much they, if they want to play like an ostrich and stick their head in the sand, they can do that all day long, but it's not going to change. The genie's out of the bottle. The only way to put it back in is explicit guarantees. This is not a protection or a bailout for investors, as they got wiped out with SVB, SBNY, and mostly on CS. It is a way to keep regionals in business by keeping their deposit bases steady. As for banks out trying to raise capital, public or private fundraising, the problem still remains. How do you raise capital when you don't know what your deposit base will be in 2 weeks? So if you're wondering, or how do you invest in banks that are down 80% saying, give us equity and we'll be fine. How do you know you're going to be fine? You're going to continue to have deposit outflows. And if the Fed keeps hiking, your portfolio is going to keep getting pounded. So I don't know, I don't know what to tell you there other than the SIBs are the opportunity here. And we talked about last week why we prefer Bank of America over Wells at this point. JP Morgan's is obviously a good bank, but it's not priced with the same margin of safety that Bank of America is in our view. And if you look at the charts of the deposits to insured deposits to portfolio, and they're all out there on the sell side research, we like where Bank of America sits, and we like Brian Moynihan. He managed them through a very, very tricky situation with ease in the last crisis. So that's where our money is for that group, how to take advantage of it. Now, if you're wondering why the market sold off so aggressively into the close when it was holding up relatively well following the 25 basis point hike, which was expected by the Fed Fund future market, here you go. U.S. Treasury Secretary Yellen, we are not considering insuring all uninsured bank deposits. That's what she said at 3:30 yesterday. You can see here the tick before she said that, we were starting to recover, rallied into the Fed, sold off a little bit when he raised 25, started to re-rally, and then Yellen comes out and says that. It hit at 3:30, and you just completely rolled over. Now, it was a potent surprise to the market, as just 24 hours before, this is what came across this tape, which is what caused the rally in previous days. If the situation worsens, the U.S. is looking into ways to guarantee all bank deposits. You don't have to look into ways. All you need is an executive order, and your problem is solved, and figure out how to pay for it later, because once you backstop it, you're not going to have to go into your pocket. Maybe one or two banks that you waited too long will be toast, and it'll be some amount of money. But beyond that, you're going to see a floor put in, and things are going to take off along with the economy. So for those saying they can't change the deposit guarantee limits without Congress, that's correct. However, in times of emergency or crisis, the executive branch has the unilateral authority to act. So far, it's been crickets. The good news is they've unlocked the liquidity tools to clean up the messes they have made that are likely to continue moving forward. The balance sheet is up $300 billion in the first week. We're going to find out tonight how much more. My guess is more. I would expect an additional 25 basis points will require another 300 billion to 600 billion by the end of the year. So the question is that 25 basis points hike for quote unquote credibility after you've struck it out 3 for 3, December 2018 inflation last year and over tightening this year. In any other sport, you're out. I guess in that business, I guess tenure is key. But so is the 25 basis points worth another trillion. I guess it is to them, but apparently no one else. Here's what the balance sheet looks like. They said it's not QE, just like the ECB says buying periphery bonds a few months ago when things started to unravel was not QE. It was QE. This is QE. They can call it whatever the hell they want. This is bearish for the US dollar and bullish for emerging market equities in China after the short-term dust settles. They're not going to rally in the midst of a banking crisis, but you're also seeing gold get a bit of late. You see the dollar sell-off yesterday. Gold has sniffed out the fact that the more they tighten now, the more they're going to have to print later to clean up their messes. We're already seeing it in the balance sheet, and we'll probably see more tonight. We've been saying it for months on our podcast VideoCast. We're now seeing it in real time. So the only folks who have not gotten the memo are the ones sitting around asking themselves, how did this happen when banks blow up? When the balance sheet makes a new record high during their tightening cycle, perhaps they will revisit the question. So here's where we were, started to tighten modestly, and now we're going back up to record highs. Here are the Fed's new projections on the dot plot. They anticipate another possible hike. 2 weeks ago, the market was convinced the terminal rate was greater than 6%. Now it's at 5.1%. My guess is one more mid-sized bank closure and we'll be done where we are right now, which is 475 to 5 or right here at this level. The Fed statement changes. This is key from CNBC. The notable changes include a shift away from the words ongoing increases to the opaque phrase, quote, some additional firming in terms of policy. So that could just be rolling off more of the balance sheet, which now they're not doing, as well as saying the U.S. banking system is sound and resilient, like an ostrich with their head in the sand. It's not sound and resilient, and it's no longer going to be sound and resilient until you actually do something about deposits fleeing from the regional banks. You can tell us all day long that they're not, but at the end of the day, if you have uninsured deposits, you're moving them to the SIBs, and that's all there is to it. 4 weeks ago, it wasn't an issue. Today, it's an issue, and it's not going to stop being an issue until they make it stop being an issue. On Tuesday, I posted a summary of Bank of America's Global Fund Manager Survey. You can find it here. So we're going to go through first the 5 key points. Number 1, investor sentiment is as bearish as the great financial crisis lows in 2008 and 2009. So there's been no instance where you get sentiment this low and you don't get a monster rally. So could this be the first time? I guess it could be, but I wouldn't count on it. I would actually count on the trend thing that Alan sent, that we're going to climb this wall of worry. And my guess is the catalyst is the government's going to finally blink and put the genie back in the bottle. 2, recession fears near previous major low levels. So those are rolling over, and that's what they do right before you have these monster rallies, and particularly as you climb the wall of worry, you always get these little checkbacks on the first move down, and this time is no different. Cash levels are still high. They're starting to come down just like they did after the March 2009. They started to come down after the Euro crisis, started to come down after 2016, started to come down after April 2020. And what was that? That was huge rallies. And you get all the way down here, and then you've got a few more months before the tops start kicking in. Investors couldn't be more bearish on real estate. We think it's kind of interesting, and we're going to talk about it with one of the AMA questions, although I'm not going to spend a lot of time on it because we did spend a lot of time on it last week. And we think selectively, by managing the size and risk, there are pretty interesting opportunities out there. Managers are still running to safety. They want staples and bonds and they want out of U.S. equities, they want out of banks, they want out of REITs, and they want out of discretionary. And they want out of emerging markets. I want in all of these. So I want more in emerging markets. I want some REITs. I want some discretionary. I want some U.S. and I want some SIBs. In our case, Bank of America. Investors are overweight bonds and underweight U.S. equities versus history. So in a major way, I want all the things that they're underweight. I want U.S., I want equities, I want tech, I want REITs, and they're overweight bonds, staples, cash, sold to you, not for me. Let's look at sentiment. This is the AAII sentiment survey. It's down at 20% bullish. This is capitulation levels. So, we've been there for a little bit. I think this, we're at or near. Fear is, omnipresent in the fear is ubiquitous in the market, and it's usually near turning points, whether that's an hour, a couple of days, or a couple of weeks. I can't predict, and I really don't care. But your odds are skewed to the upside when everyone's this scared and this pessimistic. Some other things: investors' perception of risk worsened this month, so you're back down to GFC lows. Other key points here that we didn't get to cover was growing conviction in a steeper yield curve over the next 12 months. And these were periods when you wanted to be long exposure on equities coming out of the Euro debt crisis, coming out of the great financial crisis, coming out of the pandemic, etc. Moving along, we covered that. The most crowded trades are long European equities. I'm not certain that that's the case, but we have a little exposure in the UK, and we continue to like that. Biggest tail risk, systemic credit event. So that's gone up, and that's usually when the government steps in to alleviate that. So we'll see how much pain they have to take before they make the move. Earnings, this is the top 30 weights of the energy sector. George posted for 2023, top 30 weights estimates in the last 60 days are down 3.75%, which we had anticipated last quarter, fourth quarter, when everyone was clamoring for energy and we were saying no. But for 2024, they're up 1.24%. So there may be an opportunity in here to selectively start to buy for the long term. We'll start to pay more and more attention to it. I'd like to see a little more blood in the streets, but I think we're getting close to that capitulation level. I think WTI was down to 65 this week when everyone was calling for 140. So it's starting to get more interesting again. Defense and aerospace cumulative earnings power were revised down 2.84 and 2.05 for 2023 and 2024. I think that's interesting because what has everyone been pounding the table the first quarter? Defense and aerospace. Why? Because they were up and there were headlines about the Ukraine. So I think you got to be very selective here. Moving along, economic data. Existing home sales were better than expected because rates came down for a minute. You get mortgage rates below 6%. People are buying everything in sight. So, just a little relief from the Fed and the millennials will be back in the game. And that'll be game on once again, but it's going to take a little time. Initial jobless claims were 191,000 versus 197. So, still hottish, but, it is what it is. I mean, I've never seen a situation where so many people were rooting for so many people to lose their jobs. It makes absolutely no sense. Drain the liquidity, let people have their jobs, and let's get on with it. So, okay, let's move on to the Ask Me Anything questions. We got quite a few here today. So the first one is from Zachary. He says, "Hey Tom, appreciate all the help. You've made me real money. Any thoughts on when we get interested in Vornado, SL Green, Realty of the World? These crashing, anticipating a dividend cut? I'm starting to nibble." I actually, congratulations on your future Olympian. Maybe Olympians, plural, we'll see. But thank you very much. You take it day by day. They're young, they're having fun, they're doing a good job. So thanks for the question, Zach. I covered this in detail. I would say no to SL Green because they have the second tier buildings and the older buildings that have risk. I'd say selectively, yes, we have a small position in Vornado, and it's a bet on the jockey. Steve Roth, he made it through the financial crisis unscathed. This is nothing like the financial crisis. They have raised cash with some building sales over the last couple of years. The occupancy rate is slipping a few points, but not relative to the price, relative to book value, relative to funds from operations. So I think that there's more pain coming, and I think most of that pain is priced in. I also think that the stock will start to rally when they cut the dividend, and I'm fully expecting them to cut the dividend, and that will be the catalyst to maybe lean in a little bit more. But for now, we're comfortable. This is a new position, but also sized in a way that it could be a donut hole. So, it just depends. I'm counting on the benevolence of strangers here, which you never really want to do, that the government and the Fed and the Treasury will come to their senses and realize the knock-on effects of the behavior of the last 12 months and remedy their ways before they're proactively versus now they're reactive, but before it really becomes reactive and you have a bunch of Congress people doing all-nighters trying to figure out how to come up with a couple $1 trillion to fix a hole that they created unnecessarily. So I don't think it'll get to that. I think they're going to move a little faster. Last time they took 48 hours too long. This time maybe they'll take 72 or 100 hours too long, and then they'll panic when they see all their government 401ks getting a little volatile, and they'll act. Next question is from Dominic Harlan. Hey, Tom, I was wondering if you could look at Newell Brands. It's the world's largest global consumer goods company that I believe is down due to the market cyclicality. I think it's a good investment as it is an extremely stable company that could do well once the market turns around. Thank you for your insight and keep up the great work. Okay, thanks for the question, Dominic Harlan. Let's take a look at Newell. As a matter of fact, Newell did come across my radar in recent weeks, and we haven't done anything with it yet, but that doesn't mean it's not a good opportunity, but I can start to see why. Okay, so you can see here their profit margins are declining, their free cash flow is negative. Their cash from operations is negative. Their return on equity is flatline. So you could say, well, this is temporary because of the pandemic, but then I would ask you, why was it still declining in 2018, 2019, and 2017? Why have it continued to decline? So the quality of the business has continued to deteriorate. Now, that doesn't mean that it's permanently impaired, but this is probably just not high enough quality. This is one of those, I think, that's going to be like, hey, this is a trade. This will probably work from $11 to maybe $20 or $25, but it's not a good enough business that I can own it and sleep well at night, that it's going to improve. But let's just take a look at some of the facts here. I think I actually have a value line tear sheet pulled up, which I love because that's what Buffett used for many decades and still does. And it just puts all the simple information in one place. So their cash flow from operations is the same from today as it was in 2007, and ironically, so is the price. So no improvement in fundamentals, no improvement in price. You'd have to have a clear understanding of what is going to change in the underlying business that's going to cause them to actually start to grow. And this is the difference between what we do and what a traditional value investor does. Traditional value investor looks and says, oh, this is trading at a discount to assets. This is a cheap PE, whatever it happens to be. We rarely even look at PEs. We look at their ability to compound capital. And as you can see, for the last decade, the return on capital has been low single digits. This is a low quality business with no moat. Their return on equity is a little bit better. Their sales are, they're 8.6 this year, so that's the trough. They'll go back to 9.4, but they were doing 9.4, 5, 6, 7, 8 years ago. I think this is a tradable stock. I don't think this is a business I want to own forever, and I don't think it is a business, if I had unlimited capital, I'd want to buy in the private markets and run it. I think it's just a grindy, low margin, competitive business with brands that have no clear moats, because you wouldn't run a return on capital that low. Let's look at their gross margins. It's been declining from 35, now it's down to 30. I mean, it's not a terrible business with a 30% gross margin, but there are better places. Operating margin is high single digits. That's okay. Cash flow, it's been negative, unpredictable. This is a trading business. This is not a... I think this will work for potentially a double over a few years, but it's not something that I would like to do. I think your thought process is correct. I think it's just the risk reward is for only this would have to be a potential like 10 bagger for me to be willing to take that risk, and I'm not. So let's try Alan. Andrew W. Hey Tom, big fan. Been listening weekly for a couple years now. Thank you for that. Liking the recent Q&A regarding individual companies. Wanted to throw a ticker your way and see what you think. CPRX. I took a look at some of the financial. Looks solid. Saw there's been some solid insider buying in the last few months as well. Would love to hear your thoughts. All right, I've never heard of this one. CPRX. Okay, this thing is near record highs. It's at 20. It was up to $22 from 51 cents. I think you may have missed the train, my man, but let's see. CPRX. This is Catalyst Pharmaceuticals. Right there, I get a little nervous because I do not want to predict what drugs are going to work as much as I can avoid it, unless it's some big pharma with already proven stuff. These smaller companies, I want to own a basket. That's why we own XBI. Yeah, so it looks like they got some hot drug that's starting to work. Market's priced in a lot of that good news. 74% gross margin. So what is the drug? What's the magic drug? Biotech focuses on commercializing therapies of people with rare, debilitating, chronic neuromuscular, neurodegenerative diseases. Offers Firdapse, an amifampridine phosphate tablet for treatments with Lambert-Eaton. This sounds like a company that has one drug that they charge a ton of money for because they can, and it has a limited population. And these things, sooner or later, they can run, but that's not the game I want to play. You're gambling that the insurance companies and the government and single payers are going to continue to tolerate the very high prices, and this is going to persist in perpetuity. It very well could. That goes in my too hard pile. So what I would suggest with that is why is there going to be no competition? Why are the margins going to stay there? What is the size of the market? When does that get tapped out? Is it a one-time thing? Is it a recurring thing? Go to the investor relations, read all of the annual reports to start, listen to the conference calls, the investor presentations, and you can decide if you think this stock is going to do another 40 bagger on top of the 40 bagger it did in the last 7 years. And for me, that goes in the too hard pile. But thank you for the question and thank you for listening. Kevin McAllister, Tom, been a listener for some time. Thanks for the great episodes. I have shared them many times. Thank you for that. By the way, if you're finding value, greatest compliment you could pay me is just share it with one friend and say, hey, I found these helpful. I know you like markets. Maybe you'll find it helpful too, if that's the way you feel, and that's how it grows. So I built a recent position in BABA, was looking at Stone, STNE, Stone Co. as I feel the US dollar will start to slip, and want some other foreign market exposure. I really like the continued growth it's showing, increase of 10% new customer base each quarter, cash to debt ratio, among other things. Don't mind that Berkshire is holding from much higher levels. Any thoughts are appreciated. We have a little flyer position in this to keep an eye on Brazil until it turns. The problem with this is that I'm not as bullish about Brazil as I am about China. And but to your point, if the dollar weakens, this country will start to get bid. This company deals with consumer credit, and what I get worried about with a socialist government is when the economy slows and all these people start defaulting on their consumer loans, whether Lula steps in and interferes or whatever. I would say that's a low probability, but it's not a high conviction for me, but I do have a flyer on it to pay attention, and may add, if we get some backstop in the banking system and I have confidence that credit's going to hold together, then I would consider getting involved in a material way versus just having a small position to kind of keep my eye on it, keep my eye on the country until it turns. But let's just take a look here. I mean, these operating margins are sporadic. The gross margins are solid, although that's not ideally how you want to read this type of business. EPS is negative. Let's take a look at the balance sheet. I mean, you just don't know what loans are on this. That's the big issue. Cash flow from operations cut in half year on year. Free cash flow cut in half. Yeah, I understand what you're saying. There's not a whole lot to find wrong. I would want to make it a real position. You'd have to do more work on the portfolio and the credit risk that they have and kind of the unemployment rate and the composition of their clients, how low end or high end they are. There's a lot of work that has to go into this, but I do think you're right. This is basically a leverage bet on the dollar and a leverage bet on the government ultimately stepping in to do the right thing. So I think this will work, but I wouldn't size it in a way because you're dealing with a socialist government, number one, and number two, a very leveraged, risky type of credit profile. So if GDP in Brazil slows by like 1 or 2%, this would be the area that would get hit first, which is what's priced in. So you're basically doing a solvency analysis, and you're going to have to get comfort with the balance sheet before you size up into it. But something like this can be a multi-bagger, so it's worth doing the additional work and finding out if you're right. So I'm going to say, smallish until you do more work, and you can lean in as you get more comfort. We want our exposure to be with BABA. We've done all the work that we need to do on BABA. That's where we want to make our money, and that's where we will make our money. Gregory Brink. Hey, Tom, thoughts on Profac Holding, ticker ACDC? Good band. The title of our article this week was going to be, I was listening to it on the way home. It's going to be that AC/DC has a song called Big Balls. And then I read the lyrics and I realized they were talking about like galas, like charity balls, not charity balls, but we've got the biggest balls of them all. And they're literally talking about ballrooms and events. And that's not what I had in mind with the title, Big Ball Stock Market and Sentiment Results. But, we'll see in coming weeks. AC/DC, vertically integrated energy services company, provides hydraulic fracturing, completion, and other products and services to upstream oil and gas companies. Stock is at an all-time low. Okay, AC/DC. Never heard of this one either. Okay, first off, for me, the red flag number one is it doesn't have enough financial information for me to feel comfortable putting my money to work. I need to see how the business operates through cycles. how managers get comfortable with management ability to deal with adverse conditions. And this is not giving me the comfort that I need off the bat. So my guess is this will be potentially a trading stock. It might work. I think we're getting close to where you can start to add some energy exposure, but I think there's enough higher quality stuff that you could add. That would, I mean, look, everything here looks perfect. I mean, revenues are going straight up for 1, 2, 3, 4, but it's also been an energy bull market. Gross margins are going up. That's a really positive sign. As expenses, so they started to go EBITDA positive. $4 a share. What's the thing trading at? $21. So it's trading at 5 times. Balance sheet, they've got $35 million of cash, and they've got they have 0 debt. No, they've got $800 million of debt. So that's a leveraged balance sheet, my friend, and that refinancing. So you got to go in and find out, when does this debt come due? They took out a lot of debt last year. When does the debt come due? What are the terms? If they have to refinance in the next 12 months, we don't know. I mean, we were lucky with Cooper Standard. They got it done. They did a fantastic job with them. So now we don't have anything to think about for 4 years other than car volume going up, which it will, and operating leverage, which is going to be a monster. But here you got monster increased cash from operations, cash from investing, huge capex, and obviously in that business. Free cash flow is turned positive. So Gregory, I think you just have to do a little more work and understand the balance sheet. When does the debt mature? What are the terms? What is the refinancing risk? What areas are they working in, et cetera? And it might be okay for a punt, but I wouldn't be an investor. I wouldn't want to own this business, is what I'm saying. I think this is something you want to trade versus own in perpetuity. You think about this like a punch card. Buffett talks about, if you got a punch card with 20 marks and those are the only 20 investments that you could make in a lifetime, would this be one of those? Would you take a gamble on 1 out of 20 over a multi-decade investment horizon? This would not be on my punch card, so therefore I'm a pass. Pablo, but thank you for the question, and I think it could work for you. It just needs a little more research for you to get comfort. Pablo Lockman, Thomas, I've been a long time subscriber. I've learned a lot from you. I'm 23 years old and work at Schwab. I'd love to hear your take on Charles Schwab stock and business, given the large decrease in Schwab over the last couple of weeks as it got caught up in the recent bank financial meltdowns. I believe this is a great buying opportunity for the long term. The share price drop has nothing to do with the fundamentals of the business, which are very strong and growing, have no similarities to the banks that are in trouble with the recent Fed actions to backstop liquidity. Many executive directors of Schwab pounding the table this week, buying millions of dollars of stock for their personal accounts, having $14.5 billion of client inflows in 5 trading days, being well capitalized, and having a conservative risk model. Do you think it's a good long-term play? As Buffett says, opportunities come in frequently. When it rains gold, put out the bucket, not the thimble. Thanks for your weekly podcast and daily updates to the website. P.S. I showed your stuff to my dad and he loves it. Okay, so let's see here. Schwab. I think Schwab's okay. I mean, I don't think it's come down enough if the government stays asleep at the wheel. And the reason I say that, I mean, this is a great business. You look at the revenues continue to grow, earnings continue to grow, gross margins staying relatively high. Free cash flow, though, is kind of taking a hit. So let's take a look at that. I think for me, Schwab is still a little rich. In other words, it's a great business. I agree with you on that. I think it's a great long-term hold. But okay, so they're also digesting this huge thing of TD Ameritrade, which gives them a greater moat moving forward. So you see this big jump in revenues, operating income. I mean, this is definitely a great business. I just don't know if the price has come down enough for me. Yeah, the cash flow is coming down. That's because of the TD integration. Free cash flow is major negative. Double-digit return on equity, return on assets. So if you look at the great financial crisis, it went from 23 to 9, so it came down like 60, 70% in between there. Here it's come down from 94 to 52. It hasn't quite dropped 50%. I think when this thing, maybe it did already, and it already did, and it bounced back. Let me take a look at this, Schwab. What's it trading at today? $52. Small dividend. I mean, you still have Charles Schwab Bank. I think there was a stat out that you could get a 95% flight of deposits from the bank side of it and still be perfectly fine. So that's a good thing. Consistent double-digit return on capital. I think you're probably okay. I think at the end of the day, if you buy this here and hold it for a long time, it's going to work higher, back up to new highs over time. The thing is, you know, if this was $40 or $37, I'd be pounding the table and probably buying a lot of it. But it may never get there. It is a high quality business. So I think you're okay. I think your philosophy is okay. It's a pass for me, Pablo, but I think it's generally okay. Let's see. Job training, banner year, or position consolidation of the asset management and broker industries, short-term investors. I mean, they are building a nice moat after the TD consolidation. They also make money on the money that just sits there in cash, so that's a good thing. I think it's okay. It just hasn't. It's okay. We're close to a level where I'd be wanting to buy a lot. We're just not there, and I'm just not. I'd rather play this short-term dislocation through Bank of America, to be honest, because they're going to be a beneficiary of this. Schwab is going to be perfectly fine with this. So they're basically in the brokerage business. I didn't really love the brokerage business at all. The only thing I love about this is the fact that it's big and it's come down a lot. I just generally don't like that business. I wouldn't buy Interactive Brokers. I wouldn't buy Schwab. I wouldn't buy TD if it was a standalone. I wouldn't buy E-Trade. Morgan Stanley bought E-Trade. I wouldn't buy Coinbase. I just don't like the business generally. But the Schwab business has a beautiful RIA or financial advisor business and custodies a lot of assets. I think it's got a nice moat. It's a quality business. Yeah, you're fine. I think that's a good thing. And if it goes lower, you can buy more. You're a young guy. If it gets down to the low 40s or high 30s, which it probably won't, you could add to your position and just hold it for some time. Let's see, what is the next one? Oh, one last one. LXU from Kevin Aman. What do you think about LXU? Thanks. Okay. LXU. Never heard of it for starters, but okay, so it's run up from 80 cents to 10 bucks. So you're betting that it's going to be another 10 bagger. I will generally take the other side of that, but let's see what the facts say versus the opinion. All right, so their revenues have started accelerating, their gross profit margin has started accelerating, their cash from operations has started accelerating, and that was probably known, which is why the stock's up 10x. Let's see, what do they do? LXU. Okay. So they're growing. Let's see. Manufacturing, marketing, and sale of chemical products. The company provides nitrogen-based fertilizers, ammonia fertilizer grade. So this is like a mosaic type of thing. And the CF Industries. Yeah, all of the group is kind of getting interesting. Let's take a look. So revenues are up 3x in 6 years. Margins are now improving. It looks like they have some operating leverage. That's good. EBITDA positive, earning $2.60 a share on a $10 stock. That's kind of interesting. $9 stock. Balance sheet, $63 million of cash, $702 million of debt. That's what you got to watch. You got to know the terms of that debt, because they're going to, you better hope that's a few years out. So the Fed is cutting by then and they can refinance it with ease, because if any of this is coming due in the next 12 months, it could be harder than expected. And that's the problem. Cash flow statement. Yeah, I mean, they're generating huge cash from operations. What did they do here? Investment in marketable securities. They took a write down. Free cash flow. Yeah, so, it's good times. The stock is up 10x because of its good times. So what you got to do here is figure out why those good times are going to continue, and what has changed where it's gone from a, looks like a cyclical business here that does well and then does poorly again. Why is this time different? Why is it going to stay good? What's changed? And the answer to that question is these type of businesses never stay good. They're cyclical, the ags and the commodity businesses. So what's changed since 2016 or so that's now causing this to hockey stick? Is it some new product that has a moat that can't be replicated? What has changed? And if you can get comfort that things have changed for the good forever and they won't be competed away, the advantage that they're showing in the last 24 months won't be competed away, then yeah, maybe it is another 10 bagger. But I think a lot more work needs to be done, and these tend to be very, very cyclical businesses. As you can see, it has a tendency to do this pretty regularly. But it may be coming out of it, so it could be grinding. So anyway, so do the work on that. What's changed? Why is it going to be better? Why is it not going to, fall into another cyclical rut again? And then, but so far so good. And most importantly, the balance sheet. That's of critical importance right now. So with that said, I want to thank everyone for tuning in. We're going to be back same time, same place next week. In the meantime, thanks for tuning in. Make it a great one. Bye for now.